Have you ever looked at your portfolio and wondered if you are actually holding the next big winner? Or if you are potentially holding onto a ticking time bomb that is about to wipe out your hard-earned savings? With the rise of AI and massive shifts in consumer spending, are the assets you own today positioned to survive the next decade? If you feel like the stock market is a party where everyone else is making money while you're stuck on the sidelines, you are not alone. Maybe you are afraid to jump in because stocks seem to hit all-time highs every single day. Or perhaps you have already dipped your toe in, only to see your account bleed red, and you honestly have no idea how to fix it. Today, we are going to fix that. We are going to stop the guesswork. I am going to walk you through a proven 4-step framework that will take you from a confused beginner to a confident investor. By the end of this video, you will have a clear roadmap on how to filter out the noise and identify companies with real potential. But before we get to the charts and numbers, let us get real for a second. Investing has a very low barrier to entry. Anyone with a smartphone can buy a stock in seconds. However, the barrier to actually making money is incredibly high. You have probably heard the golden rule that you should only invest money you can afford to lose. That is your idle cash. That is money you do not need for rent or groceries. But once you have that cash ready, you need to ask yourself 3 critical questions. First, what is your actual goal here? Are you just trying to make enough for a nice vacation next year? Or are you building a retirement fund that needs to compound for 20 years? Second, what is your pain tolerance? If your portfolio drops by 5% tomorrow, are you going to lose sleep? Or are you willing to stomach those wild swings for the chance at a much higher reward? And third, where is this money coming from? Is it stable? Once you have honest answers to those questions, we can move on to the fun part. There are thousands of stocks out there. How do we find the needle in the haystack? We are going to break this down into 4 core steps. This brings us to our first step, which is selecting the right industry. I want you to remember a quote from Charlie Munger. He said, "You have to fish where the fish are." Think about the importance of momentum. There is a saying that if a pig stands in a wind tunnel, even the pig will fly. The wind is that powerful. Conversely, if you choose a dying industry, it does not matter how amazing the management team is. You are fighting a losing battle. So, how do we find these industries? We look at 2 specific directions. First, look at the macro trends. You need to keep an eye on the news and government policies. Where is the money flowing? For example, look at artificial intelligence right now. It is receiving massive government support and corporate investment. That is a sector where the fish are gathering. The second direction is to look at what you already know. This is your circle of competence. If you are a software engineer, you understand tech stacks and SaaS products better than 90% of Wall Street. Use that advantage. But even if you are not a tech pro, look at where you spend your own money. Look at companies like Coca-Cola or Costco. These are simple, consumer-facing businesses that you interact with every day. If you see lines out the door, that is a data point. Once you have picked a sector, say the beverage industry or consumer tech, we move to step 2. This is where we analyze the company's basic fundamentals. We need to figure out who the winner is. You should take the top 3 to 5 companies in that industry and line them up against each other. First, ask yourself how they make money. This is their business model. You want to choose companies that are simple to understand. Coca-Cola buys sugar and water, mixes them up, bottles them, and sells them. It is clean, it is easy to track. For a beginner, simple is always better. Next, you need to look for their moat. This is the advantage they have that competitors cannot easily steal. Why does Coke sell more than Pepsi? It is the brand. Why has Nvidia's stock price skyrocketed while Intel has struggled? It comes down to technological leadership and management execution. We are looking for companies that have a secret sauce, whether that is a patent, a brand, or a distribution network that no one else can touch. These are the factors that drive stock prices up over the long haul. Now that we have a great company in a great industry, we have to look under the hood. This is step 3, giving the company a financial physical exam. Warren Buffett talks about this constantly. You have to read the financial reports. I know accounting can be dry, so I have stripped this down to the 5 most critical indicators you need to watch. Number 1 is revenue and net income growth. We want to see these numbers going up. If a company is growing its revenue by more than 20% quarter over quarter, that is a strong signal. That is a growth stock. Number 2 is gross margin. This tells us about their pricing power and cost control. Now, be careful here. You cannot compare a software company to a car manufacturer. Software will always have higher margins. You should use this metric to compare a company against its direct competitors in the same industry. Number 3 is ROE, or return on equity. This is a favorite of Charlie Munger. It measures how efficient the company is at using your money to make more money. If a company can maintain an ROE above 15% for many years, you are likely looking at a very high-quality business. Number 4 is debt ratio. We generally want to see a liability to asset ratio of less than 50%. This is about safety. In a recession, companies with low debt survive. Companies with high debt go bankrupt. It is that simple. And number 5 is the net cash to profit ratio. This is a secret weapon that many people ignore. It helps you spot companies that are making fake money. Sometimes a company will report a huge profit on paper, but the cash hasn't actually hit their bank account yet. If this ratio is low, be careful. The higher the ratio, the more real the money is. We have identified a solid business with clean financials. But that brings us to dimension number 4, which is understanding the current valuation. There is an old saying that a great company is not always a great stock if you pay too much for it. The market is forward-looking. Sometimes, the stock price has already priced in the next 3 years of perfection. If you buy at the top, the company could do great, but your investment returns could be zero. We use 2 main tools to figure out if the price is right. The first is the PEG ratio. This stands for price or earnings to growth. The formula for this is PE ratio over the projected annual EPS growth rate. This is an advanced metric that levels the playing field. Generally speaking, if the PEG is less than $1, the stock is considered undervalued relative to its growth. That is usually a bargain. The second tool is the dividend yield. If a company is paying out a dividend yield consistently above 3%, it means they're sharing a large chunk of their profits with you. This is great for fighting inflation and is ideal for long-term holders who want stability. So, ask yourself what you prefer. Do you want high growth, where you are looking for massive capital appreciation? Or do you want high stability with lower debt and regular dividend checks? Let me know in the comments what your investment style is. We have covered the 4 steps to picking the stock. But the final piece of the puzzle is how to protect your money so a single mistake doesn't wipe you out. We need to talk about diversification and position sizing. You have heard it a million times. Do not put all your eggs in one basket. However, you also shouldn't have too many baskets. I recommend holding between 5 and 8 different stocks. If you hold too many, you are just diluting your potential gains. If you hold too few, one bad earnings report can ruin your year. Crucially, make sure those stocks are not all moving in the same direction. Do not buy 5 different oil companies and call that diversified. You want low correlation. Maybe mix some technology stocks with some energy or consumer staples. This way, if one sector crashes, the other might hold steady or even go up. Finally, let us talk about position control. Here are the golden rules. No single stock position should exceed 20%. And never go all in at once. Buy in batches. If you have a stable paycheck, the best strategy is to set aside a fixed amount every month to buy your favorite stocks. This is called dollar cost averaging, and it takes the emotion out of the trade. Let us quickly recap the 4 key steps to finding that winning stock. First, know yourself. Define your goals, check your risk tolerance, and ensure you are only investing idle cash. Second, pick the industry. Look for government-backed trends, or stick to industries you personally understand. Third, analyze the company. Understand the business model, look for the industry leader, and identify their competitive advantage. And fourth, check the financials and valuation. Look for high ROE, manageable debt, and use the PEG ratio to ensure you aren't overpaying. Investing is ultimately about converting your knowledge into wealth. It requires you to keep learning and upgrading your understanding of the world. I hope this framework helps you make smarter decisions. In the next video, I want to dive deeper into exactly how to allocate your portfolio for maximum efficiency. If you found value in this breakdown, or if you want to see more content for beginner investors, do let us know in the comment section below. Don't forget to hit the like button, subscribe to us, and turn on that notification bell so you don't miss our next deep dive. Thanks for watching TradingKey, and I will see you in the next one. Bye for now.